All right, so you're new to investing and looking to build your portfolio with some reliable index funds. Well, in today's video, we'll cover a handful of solid index funds that trade in the Canadian market that you can start investing in today, right after this video. Now, quickly before we dive in, I want to point out that this video is geared towards beginners. So if you're more experienced, you're probably already familiar with these index funds, right? These are funds that I've personally held in my own portfolio for years at this point and continue to invest in during market dips. So unlike ETFs that focus on specific sectors, let's say, of the market for shorter term gains, like say oil stock ETFs did a few years ago, these are solid long-term investments designed for steady growth over time. All right, with that in mind, let's jump into the first one. The S&P 500 index fund is one of the most popular and effective ways to invest in the US stock market. So it tracks the performance of the S&P 500, which is an index that includes 500 of the largest and most influential publicly traded companies in the United States. This index serves as a key benchmark for the overall market, covering industries like technology, healthcare, finance, and consumer goods. Now, by investing in an S&P 500 index fund, you gain exposure to really a broad and diverse range of top-tier companies without the hassle of having to individually pick certain stocks. And this built-in diversification helps reduce risk while positioning your portfolio for steady longer-term growth. Now, historically, the S&P 500 has delivered very strong returns, making it a go-to choice for both beginners as well as experienced investors looking to build wealth over time. Now, one of the biggest advantages of an S&P 500 index fund is going to be its low cost. And this is since it simply mirrors the index rather than trying to outperform it. So the expense ratio is significantly lower compared to actively managed funds. And this means that you keep more of your returns instead of paying high management fees. Plus, with its lower turnover rate, this type of fund is also tax efficient, reducing the number of taxable events in your portfolio. Now, for my investments, I use a fund called VFV here in Canada, which is an ETF offered by Vanguard, which tracks the S&P 500 while keeping your costs extremely low. It has a management expense ratio, MER for short, of only 0.09%, meaning you'd only pay 90 cents in annual fees for every $1,000 you have invested in this fund. That is a fantastic deal for any long-term investor. Bottom line, if you're looking for an easy and cost-effective way to gain exposure to the US stock market, which historically has been one of the strongest year over year, well, an S&P 500 index fund like VFV here in Canada could be a good option. Oh, and by the way, if you're new to investing and want to start buying some of the ETFs that we're speaking about in today's video, or really any other fund or investment for that matter, then you'll need to open up an investment account, either a TFSA, an RRSP, or even just a regular investment account, which is why you'll want to open your new account with Moomoo, which is one of the best trading platforms for beginners who want to start investing. Moomoo has a ton of built-in functionality that's completely free for all users to access, but new to the app is also the auto buy feature, which is a very convenient investment tool that allows users, especially beginners, to invest funds and buy positions on a recurring schedule, helping lower the average amount that you spend on investments and ultimately reducing the impact of volatility over time. Essentially, dollar cost averaging into a specific position to buy shares on a set schedule. To set it up, all you need to do is the following. Number one, open up the app and navigate to the accounts, more, and then auto buy section. From here, choose your investment option by either creating a new auto buy plan or selecting a stock from top auto buy investments. And then finally, you can customize your plan by selecting a paying account and stock symbol, entering your investment amount, and setting the frequency of your purchases. It's really as simple as that. And above all of the built-in functionality, Moomoo offers some incredible sign-up bonuses for new users, like up to $4,600 in rewards, plus a 6% cash rebate on your deposits. Moomoo has some of the best functionality that honestly honestly I've ever seen from an investment platform in Canada at zero extra cost to the user, such as the incredibly low FX fees, daily investment research functionality, Morningstar analyst ratings, and so much more. So make sure to sign up for a Moomoo account today using the link down below in this video's description for the best perks available right now. Let's get back to the video. Next up, we have the NASDAQ 100 Index Fund, a powerful investment option that tracks the NASDAQ 100 Index, which includes 100 of the largest non-financial companies that are listed on the NASDAQ stock exchange. So this index is heavily weighted towards technology, featuring industry giants like Apple, Microsoft, Amazon, and Google, making it an appealing choice for investors looking to capitalize on the growth potential that the American tech sector has to offer. Now, while technology drives the NASDAQ 100, the index also provides exposures to industries like consumer discretionary, healthcare, and even telecommunications. And because of its focus on innovation and higher growth companies, well, this index has historically delivered very strong returns, especially during bull markets when tech stocks tend to outperform the rest of the market. One major advantage of investing in a NASDAQ 100 index fund is the ability to gain that broader exposure to the tech sector without, once again, having to select individual stocks. And this diversification really helps manage risk in your portfolio while allowing investors to benefit from the sector's overall growth. Plus, like most other index funds, NASDAQ 100 ETFs generally have lower expense ratios than any type of actively managed fund or mutual fund, for example, making them a cost-effective option for long-term investors. That being said, it's important to keep in mind that the NASDAQ 100 does tend to be more volatile than broader market indexes like the S&P 500, for example. And this is as a result of being heavily weighted towards tech and growth stocks. So it can experience much larger price swings, leading to higher potential returns, but also greater risk in the meantime. So for this reason, a NASDAQ 100 index fund is going to be best suited for investors with a higher risk tolerance and who are looking to capitalize on those longer term tech sector growth trends. Now, for my investment in the NASDAQ 100 fund, I use an ETF called HXQ, which is offered by Horizons, and it tracks the NASDAQ 100 while keeping costs relatively low with a management expense ratio of 0.28%, meaning you would pay $2.80 annually for every $1,000 invested. Next on the list is the TSX 60 Index Fund, which tracks the S&P TSX 60 Index, a collection of 60 of the largest and most liquid companies listed on the Toronto Stock Exchange, TSX for short. Now, unlike the previous two ETFs, this is the first one on the list that focuses solely on Canadian listed companies, providing broad exposure to key sectors in the Canadian market, such as financials, energy, materials, consumer staples, and industrials. Investing in a TSX 60 index fund is also going to be a great way to gain broader exposure to the Canadian economy, benefiting from the stability and growth potential of well-established companies. Some of the major holdings include Royal Bank of Canada, Toronto, Dominion Bank, TD, Enbridge, and even Shopify, all of which are key players in their respective industries. And this sector diversification really helps balance out the risk while providing longer-term growth opportunities, making it an attractive choice for both beginner and experienced investors. Additionally, one of the largest advantages of this fund is going to be its lower expense ratio as well compared to any actively managed Canadian fund. And this is since it simply mirrors the index rather than trying to beat it. Management fees are lower, allowing investors to keep more of their returns. Plus, another key benefit is its solid dividend yield of 3.03%, thanks to its heavy allocation to Canadian banks, utilities, and energy stocks, which are well known for strong dividend payouts. However, it is important to note that the TSX 60 is heavily weighted towards the financial and resource sectors in Canada, meaning its performance can actually be heavily influenced by fluctuations in oil prices, interest rates, and commodity markets alike. For my investments, I use XIU, an ETF offered by iShares, which tracks the TSX 60 with a management expense ratio of 0.18%, meaning $1.80 in annual fees for every $1,000 invested, a great low-cost option for the TSX exposure. And finally, let's talk about dividend-focused exchange traded funds, which are a very popular choice for investors looking to combine steady income while also looking for some long-term growth opportunities. Now, there are hundreds of dividend ETFs available on the market, each one designed to invest in companies that will be regularly distributing dividends out to shareholders. Now, one of the key advantages of investing in a dividend ETF rather than an individual dividend stock is, again, diversification, as these funds hold a wide variety, or basket we could say, of dividend paying companies, overall reducing the risk associated with any single stock or company that might cut their dividend. So a US dividend index fund tracks an index of established US companies with a strong history of paying out dividends. And these funds provide investors with the potential for both that capital appreciation of the investment itself, while also providing consistent income along the way, making them a great option for those looking to generate passive cash flow for their portfolio while still benefiting from market growth. That said, while dividend stocks provide stability and income, they may underperform during bull markets when growth stocks are leading the market, creating higher returns for investors. So any investor should consider their risk tolerance and investment goals when adding a dividend ETF to their portfolio. And really, while there are hundreds of US dividend ETFs to choose from, the one I personally invest in is iShares Core High Dividend ETF, HDV for short, and it currently offers a dividend yield of around 3.7%, meaning for every $1,000 invested, you'd receive $37 per year in dividend income, distributed on a quarterly basis. So there you have it, a handful of Canadian index funds to look into if you're building out a Canadian investment portfolio. If you enjoyed today's video, make sure to drop a like as well as subscribe to the channel. And don't forget to subscribe to Moomoo, link down below in this video's description, to open up a TFSA, RRSP, or regular investment account to start investing in Canada today. Also, if you'd like to learn more about how to start investing in the stock market on your own, I have a 100% free to watch course over on Skillshare, link down below in this video's description, has over 7 hours of content and over 3,000 students at this point, which is insane to believe. So once again, link down below in this video's description. Thanks for watching. Check out one of these two videos and I'll see you in the next one.